22nd of February 2022. The video I'm doing today is looking at options in particular. I could talk all day about options. I've spent a lot of time, especially over the last 12 to 18 months, working on options. I know a lot of traders say don't use options. I've found it to be a very good tool, particularly because you can get a lot of exposure for quite a small dollar in investment. So why I like that is there's only so much you can lose on an options trade. Look, don't get me wrong, if you put all of your money into an options trade, that's obviously quite risky, but it allows you to get, say if you wanted to buy $1 million worth of stock, well, for 50 grand you can buy options, and yes, that 50 grand could go to zero. There's plenty of times that it will, but the most you can lose is 50 grand. Now, when you buy $1 million or something, well, maybe that stock cuts in half, goes down to 500 grand or 700 grand. You don't know. Even stop losses can't save you when a stock comes out with a huge downgrade and it just drops in you 30% instantly and you can't get out. That's happened before. Happened to me with Fastly. 12 months or so ago, and it's been happening with a lot of stocks in techland of late. So yeah, lots of reasons why I like options, but today's video I'm just going to stick with 3 extreme examples and just go through some key learnings from that. The first one was it's probably the most extreme example ever, and that was GameStop. Now, a guy who went by the name Roaring Kitty, he made a fortune on this, became quite famous for it. I think he had to didn't have to do like a video chat in front of Congress in the US. So I went through and reviewed all his videos on how he sort of valued companies, put all his spreadsheets together. Like, one hell of a smart guy. So full credit to this guy. And yeah, so I went back through the publicly available information on this trade, and using the Black-Scholes model, I sort of backworked to think, well, what are the other variables that would have had to have lined up to achieve these returns that he did? So I'm not saying these figures are exactly correct. In fact, they're probably a little bit off here and there, but by and large, I think they're sort of roughly correct, and roughly correct enough to draw valid conclusions from. So when he bought the options, the share price, I believe, was $4. He paid a strike price of $12. Time to expiry, I believe, was 14 months. And we know he paid 20 cents for those options. So if I work that backwards, that's saying he paid an implied volatility of 73%. So 73% is a pretty large number. And the other sort of eye-opening thing here is he bought way out of the money call options. Now, he's obviously done that, well, perhaps not obviously at all, but I think the reason he bought such far out of the money call options was because the implied volatility was high. He wanted to get further out of the money to keep that option price nice and low. Now, the other thing that should be said is that he was also, at least in part, the catalyst for a share price re-rate. He went on YouTube, elsewhere, explaining why he thought GameStop was wildly cheap, why the hedge funds who were heavily shorting it were wrong, and that attracted a lot of interest, attracted a lot of other retail traders that go in and start buying GameStop as well. And so that, at least in part, caused a massive share price re-rate. So yeah, I think in a circumstance where you're the catalyst, or going to be the catalyst, you could probably afford to buy a further out of the money call option that perhaps what you otherwise may have. Anyway, I'm speculating a little bit there. Let's just wind the clock forward. Now, GameStop, share price went absolutely ballistic. In fact, it went to well north of $300 at one point. But for this example, I've taken a share price of $156 with 1 month to expire. So there's basically no time value left on that option. But even still, that option is now worth $148, and you can see there, because the strike price was $12 and the share price is $156. There's just so much intrinsic value in that option. So I know this sounds extreme, but we're talking a return of sort of 700x. So Yeah, interesting one. Good for him. So, okay, the next two examples are Tesla. Both extreme examples, not quite as extreme as GameStop, to be fair, but still generational wealth that I'm making trades. Okay, so Tesla's gone through periods where it's had this massive share price re-rates and then just stagnates for years. So the first time it had a big re-rate was 2013. So this guy called Emmett Peppers, who's made 100x on options twice. So again, going through the publicly available information that I've seen of the trades that he's done, and then sort of backworked it. So okay, well, how did all the metrics line up? And yeah, this is what I come up with. So I think at the time when he was buying options, the share price was $30, and this is pre-adjusted, so pre-split money. I'm guessing that he paid the options had a strike price of $50, so nowhere near as far out of the money as a GameStop, but still, pretty far out of the money. 2 years to expiry, and I think the implied volatility. Now I haven't been able to find historical implied volatility for options positions on the market. It just doesn't seem to be out there. At least if it is, I haven't found it. So you kind of have to guess your way around that a little bit. So all these things being the case, that means he would have paid a option price of about $1.63. Share price went on to re-rate after the big breakout in 2013. Went to $200. Now those options, again, assuming just 1 month to expiry, so just sort of knock out the time value, those options are now worth $151. So that's a 92x return. Yeah, big money. Again, 2020, late 2019, the share price had been just basing for years. He's bought back again. So yeah, let's go through the examples. Share price, I believe, was $60. I'm guessing he paid the options had a strike of $100. 2 years to expire again. Same implied volatility. Again, that's a bit of a guess. That means theoretically would have paid $3.60 for each option. So just moving forward, then stock price obviously had a huge re-rate. Assuming again this is just before expiry, so that means those options are now worth $322. So that's an 89x return. So 92x, 89, sort of they're roughly sort of that the 100x returns that he's got. So like I say, these numbers aren't perfect. I'm sort of guesstimating how these trades worked. These aren't the only extreme examples that I've seen out there. I've known a few people personally to make sort of this sort of money on trades. So yeah, a few sort of takeaways I want to take the sort of that these examples suggest to me are it's pretty easy to, a lot of people dismiss options. I think it's all too hard, don't really get it, don't really get how implied volatility works, risky. Yeah, there is truth in all that, but I just think if you have the potential to make even just one of these trades in your life and you allocate some sort of money to it, this has got the ability just to retire you on the spot. So I don't know why. Yeah, I mean, for me, it's a key focus area. It's definitely not an all-weather strategy. You can't just sort of turn up making this sort of money. You have to wait for doomsday scenarios like the pandemics or GFCs, or those sort of very generational type stocks like special stocks like Tesla that sort of break out of bases and then really move along. The other thing is, I mean, whether you would have had the gumption to hold on for the whole way, I don't know if I would have. I'm also looking at things of doing shorter dated options, so I don't have to give myself so much dollar exposure to start off with. But if those work out, then buy longer dated ones. So it allows me to still won't make this sort of money, but I can still make sort of huge amounts of money when the time's right. I'm going to go through that strategy in different videos. And what's the other ones? Implied volatility when you enter the trade is massively important to how much you're going to be paying for those options. Some of the recent sort of tech-based options I've seen recently, the implied volatility just seems just too high for me. And that sort of makes sense because there's been a huge amount of retail people come in through the pandemic. A lot of them have been buying calls. So I saw charts on call option purchasing has been massively at all-time highs. So probably need to see some of that excess sort of wind out a bit. So yeah, the volatility when you pay. So the volatility, implied volatility when you're buying, is hugely important to the ultimate option price that you pay, and that in turn has a huge impact on the potential return you have. So the secret sauce, from what I can see, is to pay an implied volatility that you think is being actually underrated by the market. So you can't just look at what I'm saying. You can't just look at the implied volatility in a vacuum and sort of write the trade off or say yes to a trade without looking at the overall sort of context. So in this case, this Roaring Kitty guy did actually pay a big implied volatility, but he went in with confidence that he could get that share price moving, so he could afford to pay up for it. Likewise, in a case of a blue chip, you can get very cheap implied volatility numbers, but you also have to say, well, can this blue chip move? Again, I'm going to go through that few more examples of blue chip type stocks in different videos, but you have to sort of weigh everything up into context. So how much could this share price move? Are we coming off sort of a generational sort of sell-off like a pandemic? Is this a generational stock that's still not being fully appreciated by the market? And I think that's where a bit of art comes into it, that you've got to say, well, I think it could just have a sort of serious re-rate here. And stocks do occasionally have big moves like we're seeing here. So now, whilst there's going to be plenty of times when this trade won't work out, I think this Emmett Pepper guy's actually lost money a number of times before the trade sort of finally came good. So yeah, but the secret is, I think, huge money can be made. I think, sort of research and understanding of how these option prices can drive so much is really interesting.